In this lesson, we're going to begin the process of linking together the three-statement projection model that we have created up to this point. Now, if you recall what we did in the previous videos, we started out with the income statement and projecting some of the key items there, such as revenue and expenses. Then we moved to the balance sheet and we looked at the accounts on the balance sheet that we could actually project, like accounts receivable, inventory, accounts payable, accrued expenses, deferred revenue, and so on. And then we went to the cash flow statement and tied in many of those items from the balance sheet and from the income statement to create the cash flow statement projections. What we need to do now is go back to our balance sheet and start linking together some of these items, because as you can see, if you look at the bottom here for our balance check, this is still horribly out of balance, and that is primarily because we've just not yet finished linking together everything on this balance sheet. So starting from the top here, we're going to go through each of these different line items, and I'm going to go through what you link it to, how you decide whether or not it needs to be linked, and then where you actually pull in the information from. So cash and cash equivalents, this is easy because we know that in any kind of financial model that you have, this is always going to flow in from the bottom of the cash flow statement. This is already linked in properly, so we don't have to do anything here. For short-term securities, recall what our assumption here is. We're taking the old balance, and then we're subtracting the purchases of any securities, and then we're also subtracting the proceeds from maturity and sale. The reason we're subtracting both of them is because the sign is different. When we purchase it, we want the amount to go up. When we have securities that mature, or when we sell securities, we want it to go down. So in this case, we can actually just continue with this assumption. It makes absolutely no difference because if you remember from our assumptions, we're just assuming that this stays at 0 all the way across. But nevertheless, we want to be complete, and so I'm going to paste that formula across with Alt-ESF. So again, the idea there is to essentially add any securities that we're purchasing and then subtract any securities that are maturing or any securities that we're selling. Accounts receivable and inventory, we have already projected both of those, so there's no need to do anything there. For deferred tax assets, remember how this works, that for deferred tax assets, if you're deferring the payment of some of your income taxes, then that's going to reduce your deferred tax assets. Likewise, if you have a deferred tax liability and you defer some of your income tax payment, that's actually going to increase your deferred tax liabilities. So in this case, we can actually just go with this formula that we already have here, where we're basically taking the old balance and then we're subtracting any deferred income taxes that we're not paying in cash in the current period, that we're deferring to current periods and saying that we're going to pay them in the future. So let's take this formula and I'll paste it across with Alt-ESF. We see that deferred tax assets here stay constant, which is actually exactly what we wanted in this case. Now for long-term securities, so recall what we're doing with this formula. So this one, we're basically taking the purchases of any long-term investments. We're actually subtracting those because the sign is negative, which means we're really adding them. And then we're also taking into account this other line item on here. So presumably that's any other type of long-term asset or long-term security that this company is invested in. So in this case, we can actually just continue this formula all the way across, Alt-ESF to paste everything there. We see, as expected, this doesn't change at all because we've assumed that this is 0. The purchases and sales of these types of securities are 0 all the way across over the next 5 years. Plants, property, and equipment. So what's happening here is that we need to add any capital expenditures. Again, it's a negative sign, so we actually subtract capital expenditures, but we need to add in any new investments to our plants, property, and equipment. Then we need to subtract any depreciation and amortization of that property and equipment. And then we also need to subtract any type of loss that we've had on our property and equipment, because if the value has declined, we want that to be properly reflected on our balance sheet. So once again, we can actually just take this formula and copy it across with Alt-ESF. Again, plants, property, and equipment, the idea is to take our capital expenditures and add them to the old PP&E, then subtract depreciation, and then subtract any type of loss or write-down that you've had on the PP&E as well. Goodwill we know is constant. Other intangible assets, so what we're doing here is we are taking the old balance of other intangible assets and then we're subtracting the acquisition of intangibles. So basically we're adding in any intangibles that we've acquired here. So we're going to have to change this formula around slightly to reflect the fact that we actually have amortization of intangibles present in our model now. And amortization for intangibles basically means the same thing that depreciation does for fixed assets, for assets that are tangible, assets that you can touch. The difference is that amortization applies to intangibles, depreciation applies to fixed assets. So what we're going to do here, how we're going to change this formula, is we're going to take our old balance right here, and then we're going to subtract our amortization of intangibles number. We're subtracting this because this is going to be positive. If we amortize some of these assets, then it's going to decrease. Similar to how when you have PP&E and you depreciate some of the assets, then your PP&E number is going to go down. That's exactly what we're doing for intangibles right here. And then we're going to go down, and we're also going to subtract the acquisition of intangibles. We're really adding the acquisition of intangibles here, but that's the basic idea and how we want to change this. So once again, we're subtracting any decreases from our intangibles balance, and we're adding in any additions to that balance. So you have that formula, and we'll just copy that across. Right now, this is staying constant. That will actually change because once we incorporate our intangibles and we look at a schedule for that, we'll see that we're actually going to be amortizing some of the intangibles over these next 5 years. Current liabilities, nothing here needs to be changed because we've already projected these based on our historical balance sheet. We've already linked these in, so this is all fine. These are reflected on the cash flow statement already. For long-term liabilities here, deferred revenue and other long-term liabilities are already set. What we want to do here is set long-term debt properly. So we're going to take the old balance, and then I'm going to go down to cash flow from financing. And what we're going to do here is just add in the raising and paying off of long-term debt. So if we're raising debt, we have a positive sign, which means our debt balance goes up. If we're paying off debt, we have a negative sign, which means our debt balance here goes down. In this model, we're only assuming that we are raising debt, we're never paying off debt. So basically, in this case, the debt balance on our balance sheet is going to stay constant throughout these next 5 years. So we have that, and I'll copy it across with Alt ESF. So that's about it for our liabilities. Now for the last item on here, shareholders' equity. So we know that common stock stays constant all the way across. This is a very common assumption in models like this. Yes, technically you should be taking into account the par value of the stock here if you issue any common stock, but in most models you just don't do this because it's so small that it's irrelevant and it's not even practical to take that into account. So what we're going to do is just look at these last 4 items on here. So for additional paid-in capital, remember that additional paid-in capital happens when you issue stock and it's the value of the stock over the par value. So commonly in models, what you see here is you take the old balance, then you add in proceeds from common stock, and then you also add in stock-based compensation. Because remember, stock-based compensation is also the company issuing stock. They're issuing stock or options or any other type of equity option or equity award like that to employees. And so we're adding in all those items to reflect the fact that this balance is now going up and that there's now more stock of the company outstanding or potential stock outstanding. So we can just take this formula, paste it across with Alt ESF. We can see that it's actually going up here by a good amount. That's because we have stock-based compensation in each year. We don't have common stock being issued, so in this case it's really just stock-based compensation that's flowing in here. And remember that if you wanted to be technically correct, you would also adjust common stock here for the stock-based compensation and for any common stock being issued, and you look at the par value. In this case, we're not going to bother because it's so small that it doesn't matter, and because in investment banking, usually you assume that the common stock number stays constant in models like this. Now for treasury stock, remember that this reflects any stock the company has repurchased and currently has laying around in its own coffers. It's off the open market and the company just has possession of it. So we take the old balance and then we subtract any common stock that we repurchase right here. Now notice that I just said subtract here. This is another case where you have to be very careful with the signs because you could set it up this way, but in the cash flow from financing section, usually if you're repurchasing stock, this is going to have a negative sign. So if this has a negative sign, then in your treasury stock line item right here, you also want this to have a negative sign because any stock that you've repurchased should be shown differently from common stock that's outstanding. So it should have the opposite sign. So in this case, I have a subtraction right here. I'm actually going to change this and change it to an addition. And that just makes it easier for us to understand what's going on here because we want to be sure that whenever we repurchase stock, we're reflecting it with a negative for the treasury stock account on the balance sheet. So I'll paste this across. Now for retained earnings, this one's very simple. We just take our old balance, we add in our net income, and then we subtract any dividends that have been issued here. So I'm actually going to fix this formula and set it to H141. So I'm going to press Control left bracket to look at this. We have our old balance, we add our net income, and then we subtract any dividends that have been issued here. So we have that in place. Now I'll just paste this across with Alt ESF. We see that as expected, the net income here is going up each year. And then the final item on your accumulated other comprehensive income, this is sort of a catch-all where we include any other effects in the cash flow from financing section that have not already shown up somewhere else in the balance sheet. So in this case, we're taking the old balance. We are looking at the tax benefits from stock-based compensation, as well as the cash used for equity awards in this case. And we're reflecting both of these in accumulated other comprehensive income. So what I'm going to do here is just take this formula, we're adding in both of these, copy it across with Alt ESF. So we have that in place now, and we see, looking at our balance check, that our balance sheet now balances, and so our statements are properly tied together. Now, even though I just said that our statements are properly tied together, that's not entirely true. We do have a problem here. The problem is that we have not yet taken into account our interest income and interest expense right here. And also, we do have this outstanding item of the amortization of intangibles, so we need to address both of those items. And those will be coming up in the next two videos in this series. We'll be looking at amortization of intangibles, as well as interest income and interest expense, and see how to properly tie those together and reflect those on all three statements.